Hi, thanks so much for your question. It's a really good one, and I actually have it on my list to potentially run a webinar, maybe a live event on YouTube, to answer the question, is it worthwhile to engage a financial planner? As a general question, not necessarily specific to our business, because I guess every business is going to have, different fee levels and focuses and so forth. The overwhelming sort of focus obviously is price is what you pay, value is what you receive. So, as someone that's considering engaging a financial planner, you've got to make that value assessment, which is incredibly difficult because, it can be difficult because you just don't know how everything's going to work out, of course. So to assess the value versus the fees are easy to quantify. You know what they're going to be. What is the value? Um, I guess the approach that I would take is that I think getting financial advice is really a long-term relationship. And the way that I look at it, and the way that we look at it in our business when we're contemplating looking after a client, is will the client be miles better off after 10 years? So, for example, if the client's going to pay us $5,000 a year, so that's 50 grand over the next 10 years, with some CPI, let's call it $60,000. I would want to be in a situation where I'm supremely confident that we could add multiples of that value. So, maybe 10 times the value. They'll be $600,000 better off as a result of our advice, which is not difficult, by the way, because if you just make two or three really smart decisions and then have the discipline to stick with those decisions, you can create a lot of value. But left to people's own devices, maybe they don't make those smart decisions. So it's difficult to assess, but we won't take on a client unless I'm absolutely convinced or the team is absolutely convinced that they're going to be better off. Mostly because we don't want to be in the uncomfortable position in 10 years' time to reflect and go, well, actually, I reckon this has been a complete waste of our time. Our team comes to work to enjoy the work that they do, to add value, because I go home at night feeling really good about what I've done. We were reflecting on a conversation, in fact, yesterday and this morning, where I gave some advice to some clients 6 years ago, and as a result of that advice, they're substantially better off. Their circumstances have changed, so they had to sell a particular property, but as a result of that advice, they're miles in front, and I'm happy with that. I'm not going to take all the credit for it, but I'm really happy with that outcome. That's why I come to work every morning, and so I don't want to waste my time on clients where I can't add heaps of value. To answer your question, how much surplus cash flow do you need to work with ProSolution, our team? It's going to depend on your circumstances. It may not only be surplus cash flow. There's really, whilst everyone's situation is different, and that's why I'm kind of loath to say, okay, here are the metrics. If you can tick these three boxes, you're probably going to qualify as a client. I don't like to do that because it is different for everyone's situation, and we do like to have the opportunity to meet people. Whilst now might not be the right starting point, maybe there's some things we can tell you to do to go and do these things and come back in 5 years' time or something like that. But if you're going to force me to give you some numbers around it, if I'm our minimum fees sort of $4,500 a year plus GST. We just can't, unfortunately, because of the cost of advice, the cost to deliver advice, just the compliance cost and the overhead cost before you even spend 1 hour of time is at least $2,000 a year. And then if you add the time cost associated with delivering that service, and then of course you've got to deliver and make a reasonable profit, a fair profit to deliver that service, it's really $4,500. And if you do any reading, you will see the industry's around about that level. So we're not any different to the industry. So again, if you're going to pay me $5,000 a month, sorry, $5,000 a year to look after your circumstances, you want to be in a situation where we can add substantial value. Now, again, it depends on your situation, but a surplus investable cash flow of, somewhere north of $50,000 a year, I think is kind of what you need. But it depends on how much debt you have, if you have any debt, what other assets you have, if you have any other assets, and these sorts of things. So if you're highly geared, for example, and you've got a surplus of $50,000, I'm not sure you should be paying for advice. Maybe reducing your gearing levels really the thing that you need to do in this over the next couple of years to sort of build a bit more of a headroom and get that gearing ratio down. We don't need to pay a financial advisor, ongoing fee to sort of learn that. If you already have substantial assets, and we can put that $50,000 purely towards investing, and we don't need to worry about sort of debt management, debt repayment, well, there's probably heaps of value over the next 10 years to deliver. If you have pre-existing investments, so if you've already got a portfolio, that's worth north of $1 million, for example, well, making sure that's working really well. If you invest that really well versus terribly, that's going to obviously derive value as well. So they're the sorts of things that we like to think about. Unfortunately, it's not hard and fast rule, but I guess if your surplus cash flow, let's put it a different way, if your surplus cash flow is, say, less than $3,000 a month, $36,000 a year, there's probably very little value we can add because our fees will eat up a substantial portion of that surplus cash flow. So it kind of needs to be about $50,000 because if our fees are $5,000, it's about 10% of your surplus cash flow. At least there's enough left over for us to do some work. And that's that analysis, by the way, is true for us, but really any other financial planning firm. So, I mean, if you're considering paying for financial advice and half of your surplus cash flow goes in fees, I don't know if that's really going to work for you. Great question. I'm going to do a webinar on it because there's a lot to sort of unpack, but hopefully that just gives you a brief kind of high level answer. Cheers.